All right. So the theme of a panel largely revolves around sunrise sectors, what sectors have demonstrated great exits, great returns for LPs as well as GPs. And then we get on into sector-specific funds and so on and so forth. All right. So to begin with, Anand, the data sort of seems to suggest that IT, consumer, financials has been great as far as exits are concerned for the past 2 years. What's your experience been as far as your portfolio is concerned? Where do you see a lot of success coming in terms of sectors in the past and going forward?
I think the sectors that have been identified as having created the maximum value, both in terms of volume and in terms of value of transactions. And I think, in my opinion, over the last 5-10 years, if you look at it, have also delivered the maximum returns. For us also, predictably, these are the sectors that are creating a lot of value. The 2 exits that we've had in India have been both in the financial space, and both of them have created very good value. So I think I quite agree with what Vivek has been saying on this.
MK, you've got possibly one of the most, the widest portfolios. What's your sense of where do you see exits, which sectors do you see exits creating value for your fund?
In the infrastructure vertical, we are at the front end of harvesting our Fund 1 portfolio, the vintage that was invested in 2009 to 2012. And there, we are seeing a lot of exits in the road space. And one would think that that's natural because the 2 drivers of value in the road sector is interest rates and traffic, both of which have kicked in, and therefore there's a lot of interest amongst buyers for these assets. The power space, I think we're going to see exits maybe 2-3 years down the road, because the pattern now is to invest in renewables. And people have just ignored the base load coal-fired power plants. But our sense is it's going to come back at some point in time. And then, what we call the miscellaneous sectors in infrastructure, which is telecom towers. There isn't a lot of deal activity going on out there. And I think we've seen Brookfield just commit to a large deal. Healthcare, hospitals, there are a few trades that are happening out there, logistics. So those are areas, again, there is no general pattern. I mean, in infrastructure, if you were to talk about a general pattern, I think roads is it in terms of exits. In private equity, if you were to talk about a general pattern, it's largely, rather than sectors, it's the method of exit. It's largely been a lot of secondaries. And in areas like healthcare, food and agri, fintech has been a lot of primary investments. I don't think we've seen any significant exits to speak of, Abhi. I don't recall. And real estate, of course, is a very different animal. I think it's just gone into a bit of a hibernation to begin with. So there's really not much to talk about.
Got it. Thanks so much. Manish, you've had a long history of investing in India. What's your sense?
First, thanks for having us here. If I hear your question well, I think, you will exit all the sectors that you enter, right? So I get back to what you should be entering. And I think there you have to be very careful in terms of what is it that you really understand. MK and his group really understand infrastructure. We couldn't touch infrastructure because I believe in infrastructure, you need to be owning the underlying OpCo assets. As private equity, we normally would invest in the holdcos. I would never invest in a holdco in infrastructure or real estate, just as a complete contrast to what MK does, right? So we've got to know, and if you look at private equity in India, there have been 3 or 4 sectors. There's been financial services, Anand's done a bunch of investments there. We've done a whole bunch, whether it was NSE in my previous life or AU Finance currently. Pharma, healthcare more broadly, whether it's hospitals or the pharma companies. And a lot of consumer and consumer proxies, right? So the 2 in our current avatar, we've had 2 exits in a relatively short amount of time. One was financial services, which we believe in. We think it's the best proxy. It's a leverage proxy for growth in India. And, we really believe in India, and hence it was a common sense investment. The other one, interestingly, was not because of the sector we've invested behind, but because of the theme and the type of investment it was. Part of what we do now is very few minority investments. The majority of our investments are control and control-oriented. They're irrespective of the sector, which you have to know, and you need to know how to add value. We ensure that we have an operating partner who can actually work alongside us to improve the company's performance. So in this particular case, auto component company, we had a guy who had spent 25 years at General Motors working alongside us. In a couple of years, we've increased EBITDA tremendously. That was also one which was a controlled stake, but we had a family involved alongside it, and we sold the company together to a large Spanish conglomerate who wanted to enter India, for which we got a significant bump up in our multiples. So not only did we increase the EBITDA, which is a normal thing, we also expanded the multiple expansion because it was strategic buying control. That one, I would say, only happened because we had control. If it was a minority, and all of us, even us and our previous avatars, have invested in auto components companies before, and one of the reasons we got this cheap is because of all that had happened in the 2006, 5, and 8, and we won't go into specific names. Typically, that's a sector you don't touch, right? So, but we understood a few things in the sector, had someone working alongside essentially as the executive chairman driving growth in this company, and we had on day one when we entered, we never do a control transaction, no matter how good the sector, no matter how good the company, no matter how good the management team, unless we have a good sense who are the 4 or 5 potential buyers we could sell this company to. And that's how we got out of this one. So I just want to say 2 things. One, you're right. I would say more in our minority situations, it is very sector specific, but frankly, I'd say 80% of all Indian investments have been in 3 or 4 sectors, broadly. But going forward, if you're doing control deals, there's a whole different theme we can talk about later on how we get our exits.
Great, thanks for that. Michael, what's the LP view? What's your fund's strategy, investment strategy, as far as GPs are concerned? Sector focus or sector agnostic, and why?
Sure. I think our approach to private equity investments, and if you look at India, our focus has been on the PE space and not so much in the infra, real estate, or VC space. It's more a bottoms-up approach. We analyze each GP, and the key criteria that we actually look at is actually their ability to actually manage investment cycle. So all the way from the investments to the running of the investment, and eventually, more importantly, the exits. And so it's not based on any particular strategy or any particular sector focus or sector agnostic approach. So it's very bottoms up. But that said, I think over the last 3 to 4 years, we have seen increasing trend into sector focused funds. And this is not just your real estate or infra, which tends to be the key sector focused strategy in the past, but you're increasingly seeing healthcare funds, medical device focus, pharma focus, tech focus funds. However, we are a bit shy on that because what we see is a lot of these sector agnostic funds, they typically just focus, like what Manish says, in 3 to 4 sectors. They have built up a lot of expertise, which in our opinion is not significantly different from what the sector focused fund may be selling to us or may be pitching to us. And what impresses us most is actually how they actually convince the entrepreneurs, the promoters to make the investment, and how, more importantly, with their experience, exit the business. So that's our approach typically, not only in India, but also across Asia.
Great, thanks for that view. We've seen in terms of sector-focused funds, infrastructure funds, and real estate funds, the 2 sectors that get a fair amount of attention. Let me first start with, and we're lucky we've got a good representation from the infrastructure space on this panel. Let me first start with Harsh. You mentioned that you were looking to approach the capital markets with your investment trust. Do you want to tell us a bit more about that?
Sure. So I'll just take a minute before the context on that. So I think, while the funds are classified in sector focus and infra itself is made a sector, I see from a sponsor's perspective, I think there are several subsectors of subsectors of subsectors. So we operate in a sector called power transmission. It's fairly small part of a whole power sector and substantially insulated from what all we hear about within the sector. And power transmission in India is one of the few opportunities across the world to own power transmission assets for investors across the world. Because across the world, it's owned by either monopolistic utilities or the incumbent governments. And by nature, they are extremely safe assets once they are built. So for us, the reason to approach capital markets at an asset level with InvIT is primarily because it offers a clean way to invest for investors. Under construction assets, any infrastructure assets is typically risky. There's a large development risk. And most of the people who have lost money over the last decades have lost because they mispriced that. And in both capital markets as well as private markets. And we believe it's always going to be the case. It's going to be difficult for people to price in under construction risk. And we feel that after the asset is complete, it's much easier to price in. And it's a win-win for sponsors and the investors. So they speak the same language. And therefore, we feel we can raise better capital and larger capital. We have found that investors across the world like to own assets, tangible assets, which yield income. And while it can be owned in a private way via a fund or the public way, which India and the regulators have been pragmatic enough to launch, which makes extremely compatible for both investors, sponsors, and the trust. So I think that's why we are choosing that route. Yeah.
Super. Suresh, you've got a ringside view on infrastructure investing in India for a number of years. You mentioned that you're in the middle of a third fund. What's your sense on within infra, which are the asset classes that you see attracting a lot of investment? We've seen roads get a lot of investment in 2016. Presumably that will continue. Besides that, what else is on your radar?
Yeah, I think like Harsh said, infrastructure actually is a very wide sector in itself. And one can cut it in two ways. One is the various subsectors, and then second one is, once they're completed, right? I'm not really talking about taking development risk, because that goes into a very different realm of risk taking. But after they're built, in terms of how you're going to be collecting your revenues, right? Are you going to be collecting revenues on the basis of toll from users, or do you be collecting the revenues from a government body where you're going to be relying upon that? So within that, I think the way the sectors have emerged is that within any infrastructure asset class, the underlying document is a concession document. And in infrastructure, people are generally risk averse. They like stability. They like how the particular concession agreement or a contract has withstood the test of time. And within that, we clearly see that roads is something that that has perhaps had the least volatility in terms of either the government intervention, the fact that you are able to collect revenues from people directly, then you don't have to rely upon the government to pay you on a month-to-month basis. And the third is that there is a very high degree of correlation between the GDP and the traffic, which is the underlying factor on which you acquire an asset. So just because of these 2-3 factors, not that the capital is liking roads, but the fact is the roads as a sector is kind of providing ticks in the boxes on all these criteria, which is just making it quite easy for investors, either through funds like ourselves, or in some cases, some of the large pension funds are wanting to come and do partnerships directly to do into that sector. We do expect that that sector would continue to be quite attractive. Although I must say that because it's so simple a sector and there has been a success story in that sector, there is a bit of a deluge of capital that is coming in, and not necessarily everybody is pricing that risk in now, in terms of what the valuations of typical road sectors are now gravitating towards. If we just extend that further, I think one can extend that to say that renewables would also start to fall in that category, although the risk profile here is that you're going to rely upon the government to collect your monies. But again, it's a simpler sector to understand. One can understand the risk. Contractual structures are easy. The assets have a long life, so that it allows you to withstand the vicissitudes of ups and downs. So that's going to be there. Airports is another pretty interesting sector because as India globalizes, as well as the domestic demand for traffic is quite high. So these are the top 3 sectors where I would say. The sectors which are not in the favor or difficult to price at this point in time is on the port side, because of the very difficult to project where the global trade is going to be, or the commodities are going to be there, and they have a fairly strong linkage to the port revenues. And the third, and on the power sector, because I think we all know that the policies are still unclear, and one is really not able to make a long-term case of how you're going to sell power at what price.
Got it. Thanks. One of the fundamental themes that seems to emerge is this massive push amongst Indian corporates to deleverage, and the focus that the RBI and the banks are putting on solving the NPA problem. There's been a lot of talk about special situations investing in India, but we haven't really seen too many special situation deals. MK, you mentioned on the infra side, a lot of them are effectively special situation deals where good performing assets are being sold by asset owners to deleverage, either willingly or out of compulsion. Where do you think we seem to be going wrong as far as special situations is concerned? Are the ARCs not bold enough? What is it that we need to do to fix this?
So, it's a systemic issue, right? I mean, the ARCs really cannot do much. The banks are not happy to take write-downs because 70% of Indian lending is by public sector banks who are thinly capitalized. If they take write-downs, their thin capital becomes even thinner. Nobody wants to erode capital. So there is a tendency to kick the can down the road. So the banks are not happy to take write-downs. That's step one. The sponsors of assets are not happy to let go. Now there is the Insolvency Bankruptcy Act that's going to come into force, which will dramatically switch the landscape, because so far it's been a debtor in possession kind of framework. It switches to creditor in control framework, and that's a huge shift, provided it works. In India we've tried SARFACI, SDR, S4A, deep restructuring, BIFR. So we've tried, theoretically we've tried many things, but hope lives eternal, and hopefully the Insolvency Bankruptcy Act is the answer. And then you have ARCs that have actually, and you can't blame the ARCs for not pricing the assets accurately, because the accurate pricing is not acceptable to the banks. So, the banks and ARCs have settled on a convenient way of transferring the assets to the books of the ARCs and switching the asset from a loan asset to an investment asset that gets bled away over time. And that's been a convenient modus operandi so far. But it does not help the economy. So from our perspective as investors, we are unwilling to be spending our capital and trying to resolve debt, resolve stressed assets. We're happy to buy good assets, and we've seen a lot of those deals that have been done. I mean, you've seen the GMR group in infrastructure that's shed a whole bunch of assets. You're seeing SR, they've done the mother of all deals with Rosneft. They've shed a good asset. So you've seen GVK that's shed the Bangalore asset. And if you dial back to 2010, 2011, we invest in the real estate sector as well. And we bought a whole bunch of commercial assets from distressed real estate sponsors who were in not very different a boat at that point in time. They had less holding power. They were motivated sellers. And so you got very good deals in the commercial assets at that point in time. So the distressed market in India is market for good assets, but from distressed sponsors. Doesn't help the economy because distress does not get resolved. The answer is in the successful implementation of the Insolvency Bankruptcy Act. I think the way it's conceived, it's one of the best bankruptcy codes globally. But let's see how it is implemented.
Great, thanks. Manish, as a fund whose investment strategy is to do controlled deals, presumably you must be approached by a number of banks with regard to NPAs. What is it that you look out for? How do you sift through these opportunities? What's your criteria?
Oh, great question. Listen, at the end of the day, we recognize our own shortfalls, right? We need to also understand that as a GP, our fiduciary responsibility is to our LPs to return their capital and make money on it. We also recognize, given a classic fund structure, the amount of time we have at max is about 10 years. And if you invest on average in some of the duration of a fund, you have 6 or 7 years to really turn this thing around. We have the frank belief that if it's a bit to what MK was saying, if it's a distressed asset where the P&L is broken, if the company is broken, we don't think in India we have the wherewithal in 7 years, despite our operating partners, despite our knowledge, to do a dramatic turnaround in a company. Especially if you're working, it also depends if you're working alongside the promoter or you're working against the promoter. I think in the Indian context, in most cases, you need to work alongside the promoter in order to get, and it goes back, the biggest issue is the holder of the asset, whether it's the bank or ARC, recognizing the real economic value of the asset and taking a haircut and taking a hit. That's all that's happening. Having said that, what we have started to do, and we didn't do that in fund in the early part of our history because we were the new guys on the block, but we've started to do recently is look at those businesses where the P&L is still healthy, but the balance sheet is broken, typically because of over leverage or whatever. And in those situations, we are absolutely looking at situations, but ensuring we get them at the right price from the bankers. And that goes back to the point MK was making. We will only look at those assets where it's only the balance sheet broken, not the P&L. And we believe we can do a dramatic turnaround by fixing and injecting a lot of equity and well capitalizing that asset. But in those situations also, we're only willing to do it if we get it the right price and if we work alongside the promoters. So in short, out of the 100 assets available, we'll probably look at seriously at only 5 or 6 and probably do 1 or 2.
Got it. So slim pickings. Michael, what's been your experience in terms of GPs with a special situations investment strategy approaching your fund? What's your sense as far as special situations investing in India is concerned? Is this an area of interest? Do you see your fund jumping into this in terms of allocating capital anytime soon?
I think consistent with what MK has pointed out just now, our concern in this area is actually the execution. Because I think from a regulatory point of view, there have been a lot of positive developments, and as a result, quite a lot of India-focused managers have been setting out special situation funds. I think the large one that was raised is Aon, where Apollo Group and ICICI had a joint venture. So we indeed look at all these GPs, and we also look at pan-Asian managers like SSG. Bain is trying to raise a Asia special situation funds as well, where India is also part of the focus area. Our approach today is not to invest with a country-focused special seed fund, regardless whether it's India or China today, because we think Asia is still relatively immature compared to the US, which has a very established special seed distress market. So you need flexibility to deploy your capital in the region where the opportunity arises. So that's say we continue to monitor the India situation because everyone recognizes there's a big issue that needs to be solved. When that can be solved is a bigger question, which I think nobody really knows. So at this point today, our focus is always in the regional managers whom firstly, have been around for a longer time, dates back to the Asian financial crisis, have the experience in various geography and managing very difficult regulatory environment. And we have supported GPs with that capabilities to date.
Got it. But holding that thought on regional funds, Anand, your fund is a multi-country fund. You're not investing only in India, but other geographies as well. What's your experience been with LPs when you discuss your investment strategy? The response do you get, is it different? Is it similar to what possibly GPs who have a pure India investment strategy face? Any thoughts on that?
So when we started off in 2011, when we started raising our first fund, thinking back, I think if we had gone to the market with saying that we're going to raise money for India, I don't think we would have been successful. The whole thesis was that we were raising money on a pan-geography platform to be able to sensibly allocate and toggle between the various geographies where investment opportunities are attractive. There are flip sides to it. The overheads, operating overheads are very large, and a couple of other issues. But having said that, I think the most important primary element in the whole business is the money that you can raise from the LPs. So to my mind, we probably would not have been able to raise that money if we had gone as a single geography fund or India fund. So I think that probably explains the first part. I think our experience of a multi-geography fund has also been quite good. What it does is, for example, we look at several opportunities in each of the countries. So when we do that, we find a lot of similarities. We take back a lot of experiences from each geography and apply it to that other geography. So to that extent, we are able to cross-leverage our experiences, learnings, so which has been good again. The third aspect is that, for instance, there is heavy competition, for example, for a particular sector in Indonesia, for example. So, for example, if we like the sector, we are able to do a deal in that sector in India, as opposed to Indonesia at the same point of time. So these are some of the advantages that we've seen, and our LPs have also appreciated us for that.
Great. Thanks so much for that. This year we've seen a lot of M&A-driven exits to private equity investments. Some of them have been multi-billion-dollar exits. Manish, what's your sense for this year? I know it's a bit of crystal ball gazing, but given where the fundamentals are, the continuing inflow of FDI into India, do you see more and more of this happening? I guess this is important given the fact that your investment strategy is to look at buyouts.
Listen, I think I get back to the overall macro on that one. And I think the one thing this government has done exceptionally well is clarify the economic environment and made life easy for business. Right? I'm not talking about the social aspect. It's a whole different theme. We don't want to get into beef and how much I enjoy eating beef as a Marwari. That'll get me in trouble. So we'll stick to the... And India has become really attractive. A whole bunch of foreign investors, primarily strategic, who are living in India, but also some of the larger sovereigns and pension funds. And the combination of these three driving capital into India, not because they need to, because returns have frankly been as attractive in developed markets, but in India, it sort of stands out vis-a-vis the other emerging markets. And so in addition to all the money that the Canadian pension funds are flowing into, or Brookfield is flowing into infrastructure and really helping, either going in directly or partnering with guys like MK or Suresh, what we are seeing, which is dramatically different from what it was 3 years ago, is a significant amount of strategic interest in India. So while none of our exits will be $1 billion, well, hopefully they will be, because our entry sizes are so much smaller, for our own assets, we are seeing a significant amount of demand from international strategics rather than just the domestics. And given many of them look at this as a way to enter the Indian market, they will actually pay a significant premium in terms of EV/EBITDA multiples than you would get from an existing consolidator in the Indian market. Now, I only have, in that case, a data point of 1 to show for that, because we didn't intend to sell the auto component business. We had an inbound request from a Spanish conglomerate who wanted to enter the India market, and believe it or not, which in hindsight was understandable, they preferred the fact that a private equity firm actually owned the asset, because they felt that all the stuff they'd looked at from China or in India, the level of the quality of the asset was much more significantly cleaner and better run if it was owned by private equity. So I think the confluence of the attractiveness of the macro, especially given some of the Japanese and European strategics into India, along with the larger pension funds and sovereigns who have to deploy their capital, even if it's for a bond-like return, is what's seeing a much more significant interest in doing control transactions in India. And of course, there's also the entire private equity community. You've seen a lot of deals happen with private equity firms buying out from each other. For example, KKR buying the assets from, first from Warburg, the Alliance Tires, and then on selling it to a Chinese strategic.
Great, thank you. Anand, do you see your fund being overweight on buyout as a strategy going forward? What's your thought on the fact that we have a lot more buyouts happening? How do you intend to participate in that?
I think as some of the panelists indicated, buyout is a reasonably specialized area. I would honestly admit that as a fund, we have not developed capabilities. When I say we have not developed capabilities, we've not invested and exited. We have a few buyout investments which have been made, and we are managing them. We haven't exited any of them. So at this point of time, I would say that until we exit some of them, we would probably hold on to our buyout strategy for the moment.
All right, thanks. The timer tells me our time is up. Thank you very much.